the money creation in America is potentially getting out of control. And we think the inflation is not transitory. We think it's far more permanent. We think it's embedded.
Hi, this is Steffi, and welcome to the Financial Fox, investing and innovation ideas with a twist. Yesterday, I had a great chat with Ian Williams, CEO and founder of Charteris Treasury Portfolio Managers Limited. Ian ran one of the most successful gold funds, and I wanted to pick his brain on the current market volatility, hoping he could share with us some of his secrets on how people should act to preserve their wealth. And actually, he did. So watch the episode to find more, but before going into that, remember I'm not a financial advisor, so all the content here is only for informational purposes. Finally, if you are not subscribed to the podcast and the YouTube channel, please click the subscribe button and follow us on social media to hear more when we have new interviews and also any kind of news. I hope to see you soon. Enjoy. Hi, Ian. How are you?
I'm fine, thank you. Yourself?
Yes, I'm fine. Listen, I was looking forward to this interview with you because it's been a while that obviously I haven't seen you. We haven't catch up with COVID, and I'm very interested to see what you think about the current economic situation. With inflation, with the Fed behaviors, and the price of gold, obviously, and precious metal, which is what is your main topic, basically.
All right. Well, we think the inflation is not transitory. We think it's far more permanent. We think it's embedded. And if anything, it's going to accelerate. And we think the main root cause is all the money that's being printed all over the world, especially in America. I mean, Biden just seems to have gone crazy. I mean, the latest stimulus, he's talking about $6 trillion stimulus on top of all the other stuff that's already come. So to us, it's just potentially money creation in America is potentially getting out of control, and it's almost a prerequisite that investors need to get into hard assets, whether it's property or gold or silver or anything that's going to maintain its value against depreciating paper money.
So basically, you are saying that the dollar is going to lose its power and it will keep doing it. So as the Fed said, it's transitory, where you said it is definitely not the case.
No, how can it be transitory if they keep printing and keep, if anything, I mean, US M2 money supply went up 27% year on year last year. And it's not like they're going to rein it in. They're saying they're not going to rein it in. And if anything, Biden's promising even more stimulus packages. So this $2 trillion stimulus package, where's it come from? Uncle Sam hasn't got $2 trillion. They're just going to print it. They can't get the money from anywhere else. So this is new money creation being landed on top of the existing money creation. So we didn't think it is transitory at all. And we do think that with the Chinese following a completely different policy, they're not doing quantitative easing, they're far more orthodox. So we see also a big move coming with it's a Chinese tighten policy and Americans loosen it or keep it loose. We think the Chinese currency is just a one-way bet to go up quite sharply against the US dollar. And that triggers, if the dollar starts to fall, it's on a knife edge at the moment on quite a big support level. The dollar starts to fall, it triggers big moves by American investors into gold and silver and all the other assets, and to invest money overseas as well, into anything to get them out of the dollar.
Right, that's quite a strong statement because it's a big warning then for all the investors, and I think if somebody actually believes that this is what is going to happen, then right, what you do? So you said about going into assets that they can edge against the dollar. Can you be more specific about it? Because we know gold, but let's break it down in all the other assets that could be a choice for investors.
Any commodity is going to maintain its value, and if you get enough people clambering on board, that it will go up more than the potential rate of inflation. So any anything copper, lead, zinc, any of those, gold and silver, obviously. Land will go up, and you're seeing already in America huge increases in house prices, partly due to land going up, partly due to things like lumber going up, and also now wages going up as well. So it's we just don't think that the Fed. We know why the Fed wants to say it's transitory, because there's so much debt around that if they put interest rates up, if they say it wasn't transitory, they'd have to put interest rates up. So if they put interest rates up, it potentially bankrupts the entire system, given the amount of debt around. So they have no choice but to say it's transitory when everyone can see that it's not transitory. So it's fairly simple. All you do is move your money out of things like cash and bonds and monetary assets into physical assets if you want to protect yourself. If you want to believe the Fed, you can stay stuck in treasury bonds and lose all your money in after allowing for inflation. So,
yeah, that's really crazy. So let's go back to gold, because it looks like the gold hasn't started to go up really. And why do you think that? And also, do you think that is also because we are still in a bubble, for example, in the stock market, and other elements of the market, they are still in a bubble, so gold is kind of holding back? What is the pressure that is put on gold at the moment?
well, gold had a big rise up until July last year, and it got very expensive relative to copper and silver and oil and all the other commodities. So gold's really been in a retrenchment mode. So as all the other ones have been going up quite sharply, like oil went from, when you say oil, use Brent rather than West Texas, because Brent got down to $20 in March 2020, where West Texas went to minus 40. But that was nothing really to do with oil, that was more to do with futures margin. So if you look at Brent as a proxy for oil, it got down to $20 a barrel, and it's since risen to $70 a barrel. And copper has done a similar sort of move, and silver's done. So gold in relative to these other commodities got very expensive in July. And now that expensiveness has been unwound as all the others have caught up. So gold's no longer looking expensive relative to other commodities. So it started to go back up again, because it just got into an overbought situation relative to everything else, because it went up first. And what you're seeing now is more of a, all the commodities potentially start to rise. And equities as well. Certain equities are quite a good hedge against inflation. You're much better off if you agree with us that inflation is a problem. You're much better holding equities, any equities really, than bonds. I mean, bonds are the big losers. People who sit here holding treasury bonds are potentially going to lose huge portions of their wealth in inflation-adjusted terms. So it's entirely, if people are saying, "Oh, I could lose a lot of money here," it's voluntary. You don't have to. No one forces you to own treasury bonds. Or cash. They're the assets that are going to get diminished. You could switch in. You're going to do work out what's going on, and switch your money into assets that protect you against inflation. And index-linked government bonds aren't one of them either. They're just as bad as conventional bonds when it all on, for a variety of technical reasons, which we haven't got time to go into now. But the obvious one is to buy silver. I agree with you. Silver is probably the big winner out of all this, because it's the cheapest potentially, and with the one with the most upside.
Okay, so let's stop here. What is your target price for gold, first of all, and then we can compare it to silver?
Okay, well, over a sort of to the end of the year, we could see gold edge up from sort of $1,900 an ounce to $2,300, $2,400. We think that's quite achievable, which would set a new all-time high for the price of gold.
Okay, and looking at silver, why you said that will be the big winner?
Okay, well, it's more volatile than gold. So gold goes up 10%. You can normally bet on silver going up 20 or 30% for every 10% that gold goes up. So we think silver's is right on its resistance level at the moment, just $28.5, $29. If it breaks through that, which is not very far away from doing, we think that's going to go up to $36, between $36 and $40 quite quickly.
And you think that is because obviously as a investment hedge against the dollar and the markets, but also because of the industrial demand?
Oh yeah, all things like copper. I mean, everyone's talking about how much copper you need to build electric cars. Well, you need all these modern cars need quite a lot of silver as well because all the electronics in. So there's big demand from all the new age technology needs silver because there's so much electronics involved. So you need silver to build solar panels. You need silver to build for water purification. You need silver to big usage increase in silver for all these electric cars that they're going to make. So the industrial use of silver is growing as the demand for copper and a lot of the other metals is also growing. But also with silver, it's a sort of semi-precious metal. So people use silver as a store of value where they wouldn't use copper or nickel. So no one's going to buy a nickel coin or a bar of nickel or a bar, a copper bar or something. But they will buy silver coins and will buy silver bars as saving mechanisms as well. And also they'll put money into a silver ETF in a way that they wouldn't put money, say, into a copper ETF, or a zinc ETF. So there's in savings investment demand for silver, plus there's industrial demand for silver against probably diminishing supply because silver global output in silver probably peaked in 2015. So the mines potentially aren't even keeping up with the current level of demand, never mind an increased level. So it can only be brought about really by a big increase in prices.
So let's look here. You mentioned about production of silver. I want to talk about companies they are producing or they are exploring as perhaps another way for investors to get exposure to silver rather than buy an ETF or buy silver coin. Do you have any kind of preference or any kind of company that you like more than other, or any kind of jurisdiction or country that you like more?
Yeah, well, our fund, which invests in the silver and gold mining companies, which is where you're going to get the biggest bang for your buck because the companies have operational leverage. So if the price of silver goes up 10%, some of these silver mines are going to go up 20 or 30%. So if gold goes up 10%, and then as a result, silver being more volatile goes up 20 or 30%, some of these silver mining companies are going to go up 3 times the price of the silver. So you get much more money to be made. Where our fund, about 85% of our fund is domiciled in Canadian domiciled mining companies. So that's our favorite jurisdiction. And then the rest is domiciled in the United States, the UK and Australia. So we haven't got any shares in the fund that are outside those 4 jurisdictions for like corporate governance reasons and all sorts of. In terms of what sort of company, most of the companies we're in are silver mines, Canadian domiciled silver mines, mining in Mexico and other parts of Latin America, but also in Canada and the United States as well. So that would be our favorite jurisdiction. In terms of what sort of company, we don't tend to buy the big ones like Barrick or Newmont. We do own Newmont, but it's not big holding. We tend to buy the mid-cap stocks, because we think that's where you're going to get the biggest bang for your buck. And also, if you look at the future production rates, a lot of these big companies have a huge problem in replacing the ore that they're digging out the ground. They're all on declining production profiles, where the mid-cap ones aren't. And the only way that the big companies can solve their problem of declining production profiles is to take over medium-sized companies, like Barrick took over Randgold, you see, purely because they needed Randgold's future production to offset their own declining production. And so you're going to see the big companies, in order to survive, have to take over the mid-cap space. We're in the mid-cap space, which benefit from being taken over. And our fund has probably got the highest weighting of silver relative to gold mines of any of its peer group. So we've got about 70% of the fund is silver mines.
I I hope that you enjoyed the interview with Ian. For me, this was an amazing insight, so how people should, and investors should actually reflect when they are doing any kind of investment. This YouTube interview is only a part of a longer interview that I had with Ian, and that is live on our podcast, where I also pick his brain on cryptocurrency. I will see you next time.